Well, good morning and welcome. We're at the start of a fresh day of trade. I'm Harsh Saita and with me is Snehi Shah. We're going to take you over the next 1 hour through all that's happened in global as well as domestic markets. Of course, no action on the domestic side post 3:30 yesterday, but of course, we'll have corporate news and announcements and stocks to watch out for, which we'll take you through on the domestic front as well. But first, on the global front, let's try and break down what's happening in the global market space. Snehi, take us through what's happening in global markets, US, Europe.
Absolutely. So a very good morning to all our viewers. Let me take you through the global handover that came in then. And let's start with US markets then. And stock futures were modestly higher Monday night as investors look towards the next batch of economic data and readied for the end of June and the second quarter. Futures tied to the Dow Jones Industrial Average added 0.1%, and S&P 500 futures and Nasdaq 100 futures each also gained roughly around 0.2%. Those moves follow a losing day on Wall Street. Now, the Nasdaq Composite led the way down, dropping nearly 1.2% as investors took profits on some technology stocks. Tesla slid 6%, while Nvidia, Alphabet and Meta platforms all finished more than 3% lower. The S&P 500 closed down by about 0.5%, while the Dow was finished slightly below flat. It was the sixth consecutive negative session for the 30-stock Dow, its longest losing streak since September 2022. Despite Monday's leg down, the S&P 500 and Nasdaq are still on pace to finish June more than 3% higher, while the Dow is poised for a monthly advance of nearly 2.5%. Shifting focus to Europe then, and European markets closed slightly lower Monday as investors digested weak economic signals after a downbeat week. The Pan-European Stock 600 index provisionally closed 0.1% lower to end a choppy session, and chemicals led gains up almost 1% as oil and gas stocks climbed 0.8%. Healthcare stocks saw the biggest loss, down 1.1%. So this is what the global handover looked like, slightly negative, but let's see how that pans out for our markets today, Harsh.
Well, yes, absolutely. And quickly taking into crude, Snehi, crude was at an excellent juncture yesterday when it comes to, or a very interesting juncture, if I can call it yesterday, when it comes to the fact that had Russia, or rather the whole political development in Russia spiraled out of control, it could have probably meant that around 3.5-4 million barrels per day of crude oil would have been taken off the markets, which would have seen crude oil rise quite sharply. But it's actually doused the fire because none of that has happened in Russia. So we've seen crude actually take a bit of a retreat, if not absolutely flat. So crude is around that $69 a barrel mark where WTI is concerned. We're looking at Brent of around $74 a barrel. It was inching towards 75 yesterday. So slight bit of withdrawal that we can see on both the WTI as well as the Brent on the back of that. But on the crude front, even though there has been a diffusion of the immediate tensions in Russia, there's a further threat of volatility in crude oil prices because of course, geopolitical tensions amidst the ongoing war with Ukraine. So as we tackle all of this confusion, we had Victor Katona, who tells us what the range of crude oil prices he is working with in the short term. Listen into this piece.
Well, I think that crude oil is still in for a little upside. Right now, we have Brent roughly around 75. I think catching 80 over the upcoming month is still possible. Triple digits are largely out of the picture. I think that as we move into September, October, the upside to oil prices, if anyone expects 90 by the end of the year, very unlikely. We have a mild recession in the US, most probably Europe headed into a recession too. And if the market has been paying attention to the Chinese data, the most recent ones being published by the Chinese authorities, are by any means not positive. We have the Dragon Boat Festival mobility levels being lower than everyone anticipated. So basically Chinese mobility is lower, home sales lower, construction activity lower, car sales is lower. So in general, a lot of the pent demand that people were assuming that will take place in China has not happened. So I would say 75 to 80 is the range that we are talking about, and especially in the upcoming weeks. And Q4, meaning October to December, expect a lot of weakness coming from the recession.
Right, and keeping focus on oil, the OPEC Secretary General Haitham Al Ghais also says that oil is irreplaceable for the foreseeable future. He was speaking at an inaugural Energy Asia conference in Malaysia, and he said that they expect global oil demand to rise to 110 million barrels a day in around 20 years from now. Now, that's saying that the world energy demand will shoot up by roughly 23%. So, listen into that particular piece.
Shifting focus then, let's look at all the important cues that you should be keeping on your radar today in trade. You've got a bunch of annual general meetings happening today with the likes of SBI, Asian Paints, Bank of India and Havells having their AGMs today. On the corporate action front, you've got Hindustan Aeronautics. The board meet will consider stock split today. On the IPO front, you've got Cyan DLM's 740 crore IPO that will open for subscription today. Lock-in period will end for Ellen Electronics that listed on the 30th of December last year, and the lock-in shares were 2.5 crore. And other events to watch out today will be PM Modi will launch 5 Vande Bharat Express trains, Bajaj Triumph, the Triumph model of Bajaj will launch today, and today is also the micro, small and medium-sized enterprises day, so keep an eye out on all these cues today.
Right, and let's quickly move on to what's happening in the global marketplace when it comes to specific companies. Tech giant Meta announced a virtual reality subscription services called MetaQuest Plus at $7.99 per month. The subscription service marks Meta's latest effort to generate recurring revenue from its Reality Labs unit, which is developing virtual reality and augmented reality technologies.
Consulting giant Kpmg will be laying off as much as 5% of US workforce amid economic headwinds and historically low attrition rates. Remember, the firm had cut around 2% of US workforce in February, making it among the first few firms to slash jobs in the country. The latest job cut will take place through the rest of 2023.
Right. Meanwhile, the S&P Global has gone ahead and slashed their China growth forecast amid macro uncertainty and country's recovery trajectory from the pandemic. The S&P now expects China to grow at around 5.2% in 2023 versus the earlier estimate of 5.5%. This is the first time that the firm has cut China's growth forecast this year.
Now, the Japanese government-backed fund has proposed a $6.3 billion acquisition of semiconductor giant JSR while citing the strategic emphasis on critical technology of chips. This deal comes at a time when Japan-based stocks are witnessing a run-up, fresh highs, which have not been seen since the 1990s.
Right, and on to the latest update from Russia. President Vladimir Putin commented on the Wagner Group, stating, and I quote him, "This is criminal activity which is aimed at weakening the country. This was a colossal threat," unquote, said Putin in a televised address to the nation. This comes after hundreds of Wagner Group mercenaries led by Yevgeny Prigozhin marched on Moscow over the weekend in what appeared to be an armed rebellion against Russia's military leadership. Meanwhile, oil and natural gas prices climbed Monday as markets were largely focused on the turmoil in Moscow, which could have disrupted global commodity supplies. Listen in to what geopolitical experts had to say on this piece.
Changed course because he faced resistance from the Russian army. So there was actually no resistance. There's something else seems to have happened, and this is an abiding mystery. At what point, who intervened, why, how, that he said, okay, I'm stopping and I'm going, I agree to go off to Belarus and we'll stop this situation here.
He thought probably that he has arrived now, and maybe this one theory is that the foreign intelligence and Ukrainians and some others and somebody in the Kremlin, as well as some other oligarchs who were against Putin, have tried to bait him into it. Second, the more plausible theory that is there, and which Putin, being a strategist himself, is that it was to redeploy these forces in Belarus, which is becoming increasingly a front against the NATO and the West, and that to put pressure on entry through Kyiv.
Believe that he would do anything without really thinking of long-term consequences, anything that could actually break the Russian security. So what I think really, I really don't know. Maybe there was a plot, maybe there was not a plot, maybe he got enticed by the CIA, maybe he did not, maybe he wanted to march on. But the fact is that at the end of it, in terms of the overall security scenario, he realizes that he cannot live away from Russia.
All right, and shifting focus from what's happening to Russia to the US then, and Starbucks workers and LGBTQ activists have gathered outside a Starbucks store in New York's Manhattan to protest the removal of pride decorations across multiple stores of the flagship cafes. Protesting workers took part in a nearby pride parade and handed out flyers about the action, slamming the coffee chain for removing those decorations. A company spokesperson, however, shut down those claims, sharing their support for the LGBTQ+ community, even calling those claims false.
Right, and let's quickly move on. S&P Global Ratings has in fact retained India's GDP growth rate for FY24 at 6%. According to S&P's quarterly economic update, India will be the fastest growing economy among the Asia Pacific nations. The recently released report also shows the fastest growth in India, Vietnam and Philippines at about 6% or thereabouts. The rating agency has also lowered China's forecast, we did speak about this, to 5.2% versus 5.5% for 2023. The S&P expects RBI to cut rates only in early 2024, as the RBI wants consumer inflation moving towards that 4% target.
And it's a mega exclusive then with ITC CMD Sanjeev Puri. He says they will continue to invest to grow, expand and upgrade technology. Also adds that their dividend payouts will also continue. Listen in.
So, Mr. Puri, what we understand is that large part of FMCG capex, the critical capex, is over. The business is now cash generation, which is generating free cash flow. So, can one assume that now you'll have more cash in your kitty, so dividend payout ratios will improve? You don't need that much cash because most of your businesses are now self-sustaining.
Already we have a very handsome dividend payment policy.
It can always increase more.
80 to 85%.
Yeah.
I think the balance is certainly need as growth capital because it's not merely capex. It is also, for acquisition. Inorganic growth is another vector that we have identified. So both we have to service. And let me put it this way, that earlier our capex was maybe much higher as compared to the size of the business because we were building the foundation and we were building for scale. Now,
Okay,
also
sir, you can actually pick up a biscuit here, and I must say that
we will continue to invest.
I must say some mom's magic,
Yes.
right off the shelf, right?
Yes, absolutely. But let me finish the piece on
Yes,
capex.
please, yeah.
I must finish it. See, now we will. It's not that we are not going to invest. We will invest,
Yeah.
but it will be more calibrated and in the context of growth and size, and of course technology upgradation and so on and so forth. So at a company level, last year we launched 5 facilities. Construction of 3 more have started this year. 2 are food plants,
So you already have 11.
11 ICMLs.
Okay.
The 5 is across businesses.
Okay.
Okay. So now we have started 2 food facilities and 1 facility for sustainable packaging. So ICMLs, yes, we have 11 of them.
Right, let's slip in a very short break. We'll bring you more on the other side. We'll slowly start shifting domestic. Welcome back. Let's quickly move and understand where Asian markets are currently looking or what they're really doing at the moment. Largely mixed as we see it, but on the back of US and especially the fact that tech stocks in the US took a bit of a beating yesterday of sorts, 1+% lower for the Nasdaq. Asian stocks are also largely mixed. We also saw the Dow marginally lower, so we're seeing those kind of trends at the moment. The Shanghai is up around 1/3% or thereabouts. The Hang Seng too holding on to some amount of gains, which is definitely a positive given the fact that Nasdaq really closed in the red. So you are seeing the Hang Seng up around 1.3% at the moment. But let's quickly look at the Nikkei, which is actually looking lower in early trade, or almost looking at 1% lower on the Nikkei. The Kospi too in the red at the moment, around 1/4% lower, and the SX 200 currently in the green. You're looking at 0.5% higher on the ASX 200, but largely mixed cues coming through. We're looking at the SGX Nifty indicating an absolutely flat start, possible positive bias from yesterday pouring into today, but other than that, really hoping for an 18,700 plus open at the moment.
Hi there, and thanks for staying tuned to Market Cafe. Let's shift focus to big boy Reliance then. And the company has given negative returns for the first half of calendar year 2023 for the first time in 7 years. My colleague Somit has put together some interesting data to put the returns picture into perspective. Now, what led to this, and what are the key triggers behind such figures? And is there a potential for a bounce back anytime soon? Somit, tell us.
Well, if you see, though Nifty on a year-to-date basis has gained nearly 3%, it has not been quite a good start for Reliance Industries in the first half of calendar year 2023. In fact, for the first time since 2016, Reliance Industries has given a negative return in a first half of a calendar year. Now, what are the reasons behind this decline? Firstly, if you see on the refining segment, the gross refining margins have been muted of late. Now, in the fourth quarter of FY23, the gross refining margins had peaked out, and since then we have been continuously seeing a decline and muted set of gross refining margins when it comes to the benchmark, that is the Singapore GRMs. On the retail segment, if you see, the company has been doing a lot of acquisitions, but the disclosures regarding the same has been a bit on the lower side, and hence this has been one of the concerns when it comes to investors. Also, the growth of late has been muted because not all its acquisitions has been to fire off right now, and also there's a general slowdown in the economy. When it comes to the telecom business, there is still no clarity when the tariff hike is expected to come, and because of absence of tariff hike, the growth again has been muted. The company has been able to get subscribers, but tariff hike is the only key factor that could lead to growth when it comes to the telecom business. Now, on the debt side, in the second quarter of FY22, the company was net cash at around 3,600 crore rupees, but suddenly its debt has increased on the back of its capital expenditure when it comes to telecom and its acquisitions when it comes to retail business. Net debt has increased to around 1.1 lakh crore, and this has also been one of the concerns for the investors. And lastly, since the start of FY24, if you see the FY24 EPS since the start of this calendar year has been continuously been cut by analysts because of muted GRMs and because of the other factors that we just mentioned. And so far, if you see, the EPS for the company has been cut by around 9% from the start year for financial year 2024. So these are broadly the main concerns why Reliance Industries has not been able to outperform or even market perform as compared to the Nifty in the first half of calendar year 2023. But there are some factors that could also lead to a turnaround for Reliance Industries in the second half. Now, the first factor is the debt concerns. Now, analysts believe that the debt concerns by the street is overdone because the company has clearly shown its intent and stated that they look to keep their leverage ratio, that is net debt to EBITDA, below 1 times. Now, when it comes to retail, they have done a lot of acquisitions, and this offers a lot of huge growth optionality owing to the strong expansion spree. The company has not only entered into FMCG but also getting into the beauty segment, and all these segments, when they start firing up, the growth optionality for retail business will be huge going forward. Now, when it comes to the demerger, now Geo Financial's demerger is something that has already been announced by the company. Also, the company is expected to announce further details on this in the upcoming AGM, and also in the last AGM, the company had said that they would give some details about the retail and the telecom demerger also. So that is one of the key factors that could work in favor of Reliance Industries. When it comes to the telecom business, now though the growth has been muted off late, but the market positioning of Reliance Jio is very strong. They are not only the largest player when it comes to the mobile segment, but also the largest player in the broadband segment, and they have been continuously able to add active subscribers on their network. And when it comes to the O2C segment, though the benchmark GRMs are muted, Reliance Industries GRMs could be on the higher side because they have been getting cheaper crude from Russia, which in turn will benefit their gross refining margins. Also, the petrochemical business margins are averaging higher off late. So this is one factor that could also benefit the O2C segment. Also, one key trend that we notice is the fact that from 2015 till 2022, RIL has never given a negative return in the second half of any calendar year. In fact, 7 out of 8 times in the second half, the returns have been much higher compared to first half. So it will be important to watch out how Reliance Industries performs in the second half of this calendar year.
Right, thanks so much for that, Samit. Let's quickly go on. The government has strengthened the RERA rules on advice of Central Advisory Council. The new rule will give more protection to buyers from irregularities and cases of delays in housing projects. Prakash Priyadarshi has more details on this piece. Prakash.
The Central Advisory Council of RERA has prepared a plan to complete real estate projects on time, launched after enactment of RERA. Council is looking at various possibilities to hand over such projects to the home buyers on time. It has been decided that the builders cannot add its own terms and conditions in agreement for sale document to avoid accountability. In fact, real estate projects may not be registered if agreement for sale is not in line with model AFS. The authority may audit builder-buyer agreement at the time of registration of project itself. When it comes to monitoring system of such projects, we are given to understand that authority will increase monitoring system in a case where developer fails to submit quarterly construction report. In that case, monitoring system will be enhanced and strict action will be taken against a developer if it is not moving ahead with the set plan. Subsequently, home buyers will also be informed about the current status of the project just in order to maintain transparency. When it comes to maintenance charges in affordable housing segment, we are given to understand that a separate category will be formed to ensure buyers need not to pay maintenance charges for initial 5 years in a project which is classified under affordable housing segment. Regulator will examine this whole issue, especially in a case where home buyers are being asked to pay maintenance charges even if they have purchased a project in affordable housing segment.
Okay, thanks Prakash for those details. But moving on then, we're celebrating the World MSME Day today, and with the IPSOS survey, 6.4 crore MSMEs provide employment to 11 crore individuals. Now let's quickly look at the role that MSMEs play in India. MSMEs contribute 30% to India's GDP, 40% to India's exports, and 45% to the total manufacturing output. This is the industry figures coming in. Now let's look at MSME schemes then. And the delayed payment monitoring portal has seen 84% of cases disposed of already. The procurement by CPSE has seen 36% of the procurement done. Job Seekers portal have seen 68% of applicants already placed. The loan has seen close to 2.26 lakh loans and roughly about 67,000 crore rupees disbursed already. Now the guaranteed emergency credit line has also seen 50% allocation out of the 15,000 crore that was allocated for this. All of these are government figures coming in. And now let's look at all the government schemes that are aiding MSMEs. The credit guarantee scheme, the 67.3 lakh proposals have already been approved for 3.86 lakh crore rupees. Moving on, you've got Atmanirbhar Bharat Abhiyan, 20,000 crore rupees subordinate debt for stressed MSMEs has been allocated. The Self-Reliant India Fund, now 50,000 crore rupees equity infusion has been done for MSMEs under this scheme, and the scheme of fund regeneration, the regeneration of traditional industries is taking place under this. Upskilling of MSMEs has seen 19,407 persons that have been imparted skill training. And let's also focus to the MSME distribution that seeing manufacturing has 31%, trade has 36%, and other services, so MSMEs make up 33% of other services, and these are all estimated figures, of course. And let's also shift focus to see what states in India have the highest share of MSMEs then, and West Bengal and Uttar Pradesh share 14%, so each coming in at 14%, and this is followed by Tamil Nadu and Maharashtra, each coming in with 8% of the country's total MSMEs.
Right, that's all the focus that there is on MSMEs today, and we will continue to focus on that space. But very quickly moving on, Tech Mahindra CEO CP Gurnani earned 51% lesser in fiscal year 2023 than the previous fiscal. He earned roughly 32 crore rupees compared to the 63.5 crore rupees earned last year, and the company said in its annual report that the reduction in remuneration was due to a lower number of stock options exercised by Gurnani. Gurnani, who is set to retire in December of this year, earned around 25.5 crore in ESOPs during the 2023 fiscal compared to a solid 59 crore in ESOPs a year ago, which is FY22. The company also reported that overall managerial personnel have received 41% lower remuneration during the year due to lower stock options exercised. This comes as other IT majors also reported a dip in CEO salaries due to the uncertain economic conditions.
Alright, shifting focus from IT to FMCG then, and FMCG companies have been chomping on decent gains as easing raw material prices could aid margin growth in the coming quarters. Which segments will benefit most and which could continue to lag? Winnie joins in to explain. Winnie?
So good morning, and obviously talking about the FMCG companies, let's not forget earnings season is just around the corner, and how raw material prices move impacts the margins of the company. Obviously most of the companies have taken in terms of a cost control measure already coming in. Now look at the trends that we're seeing coming in terms of the pricing. When you look at the palm oil prices, they have seen a decline of 40% on a year-on-year basis, while on a quarter-on-quarter basis also we're seeing a correction coming in. Other than that, copra prices that have seen a correction year-on-year basis as well as on a quarter-on-quarter basis as well. We've seen wheat prices correct on a quarter-on-quarter basis, but still wheat prices a bit on the higher end when you look at it on a year-on-year basis. Quarter-on-quarter basis, yes, a correction that has come in terms of the wheat prices. Now sugar prices and wheat prices, when you look at it both on a year-on-year basis, we are seeing an increase, while even for sugar on a quarter-on-quarter we are seeing an increase coming in as well. And lastly, PFD, yes, PFAD, that on a year-on-year basis has seen a decline, but on a quarter-on-quarter basis, when you look at it, there's an uptick coming in there. So now which companies get impacted by this? When you talk about palm oil prices, mainly is used in soaps as well as in biscuits as well. You use a bit of palm oil prices as well. So yes, this is the breakup of raw material costs. So obviously in terms of GCPL soaps that they are making, GCPL 20% of the cost of raw material is about palm oil. HUL 25% is palm oil cost, that is in the raw material cost, Nestle 10% and Britannia 15%. So obviously palm oil prices correcting does benefit these companies. So yes, keeping an eye out on these FMCG companies. Let's move on and talk about some of the companies that are impacted in terms of the discretionary side. That's your paint segment. So you have crude prices, TiO2 prices, VAM and HPDE prices, that's the packing prices. When these start seeing a correction coming in, they support the paint companies and the paint margins as well. Now when you look at it in the terms of trends coming in here, both on a year-on-year basis and quarter-on-quarter basis also, we are seeing a decline in these prices. So that is surely going to be supporting the margins for paint companies. Whether you look at it in terms of Asian Paints, Pidilite, all this does start benefiting the companies as well. Other than that, rural recovery, that's an important factor that we should keep an eye out on as well, because that is something that will impact it in terms of the companies as well. And for Marico, margins are expected to flattish because not much of the basket comes from these products and these commodities. Other than that, in terms of sugar, wheat and tea, keep an eye out on that, because if that sees an increase, there is an increase that comes in the basket for biscuit makers. For tea prices, obviously keeping an eye out on Tata Consumers, because tea prices increases impacts the margins over there as well. But yes, most of them have seen a correction and expect an improvement in terms of margins for the company.
Right, thanks so much for that, Vinny, for bringing us that story. But we'll slip into a very short break. We'll go stock specific on the other side, try and get you all the stocks that will be buzzing and in news. Right, welcome back. You're watching Market Cafe on ET. Now let's quickly take it to Lisa, who's standing by or sitting with us take us through all the stocks that are in news today.
Well, good morning. A couple of management rejects have been announced by companies. So starting with Bharti Airtel. So Ajay Chitkara, who's the CEO of the company, he has decided to move on. And even Tech Mahindra's Mohit Joshi will be the CEO of the company with effect from 20th December. JS Steel has updated on their merger plans where JVTPL as well as Vardhaman Industries Limited, they have merged with the JSPCL and ceases to exist from the effective date of 26th June. City Union Bank has also announced a QIP issue, and this is to the tune of rupees 500 crore for inclusion in notice, and this will be announced at the AGM. BLS International Services Limited, they have approved the fundraising via IPO of their subsidiary, that is BLS E-Services. And lastly, Aditya Birla Capital, they have announced a QIP of floor price of around 175 per share. The opening date was yesterday, and it will be closed. And the committee meeting will be held on 30th June. This is to consider and approve the issue price. Well, as per agencies, Aditya Birla Capital will seek to raise as much as 17 billion in QIP, and the QIP price will range between 170 to 176 per share. So these stocks will be on investors' radar for today.
All right, thanks Lisa for all those details. We'll definitely watch out for all these stocks in trade today. But let me take you through what brokerages are keeping on their radar this morning. And let's start with IndusInd Bank. Now, Macquarie has maintained an outperform rating for IndusInd Bank, and the target they have kept for this stock is 1,510 rupees. They say that a 2% return on assets, or ROA, is seen over the long term. Macquarie also says that credit costs will decline for IndusInd Bank, and it also says that NIMs will rise from 4.2 to 4.3% to roughly 4.4%, and the contingent provisions will aid the balance sheet as well. Now, on the banking sector in general, then Macquarie holds the view that the impact of the increase in risk weights will be negligible for the banking sector, and top banks will be well capitalized, and increase in vintage delinquencies in personal loans can be seen. Asset provision hikes will aid the impact, and top bets that Macquarie is placing on the overall banking sector are made of names like HDFC Bank, IndusInd Bank as well as ICICI Bank. Shifting focus to Paytm then, Macquarie has downgraded this stock to neutral and has kept a target of 800 rupees for the stock. Now, the downgrade is owing to sharp run-up in share prices, and they expect accounting profitability by FY26. Macquarie also sees risks from Jio's financial foray. And moving on to electric manufacturers then, this note is coming in from Spark Capital. They hold the view on three companies in this sector, and it's for Keynes Technologies. They have an ad rating with a target of 1,637 rupees. For Syrma SGS as well as for Avalon Tech, they have a buy rating each, with a target coming in for 598 rupees for Syrma and 679 rupees for Avalon Tech.
Right, those were all the brokerage notes for you, but let's quickly take it to the stock in focus. It's been a stellar run for the company over the last couple of years, with the stock price more than doubling over the last couple of years. But does the CMD, who is Sanjeev Puri, track ITC's stock moves? Listen to that piece.
Did you get excited when the stock crossed 400 rupees and made a new high?
Well, it is always nice to hear that, because ultimately it makes all stakeholders happy, it makes shareholders happy. But, always we must come back and understand that the role of management, and this is something that it is so irrespective of where the stock price is, the role of the management is to put our heads down, roll up our sleeves, to build competitiveness, think about the business tomorrow and day after, and of course the here and now and today, make sure we deliver competitively superior value, and we leave the market to determine the valuations. Yes, it feels nice, but the task for us continues to be the same, continues to be building businesses, getting them to the next level of growth and the next level of performance.
All right, with that, we're all out of time on this edition of Market Cafe, but stay tuned to ET Now as the market takes all the action ahead.